Welcome to our webinar. I'm Bill Petrovic. I am a SCORE mentor and host of this webinar. We are going to be talking about tax tips, especially related to year end and especially focusing on small business. Although I've seen this webinar before, it changes every year, of course, but Jason is our speaker, Jason Crace from Crace and Beam CPA. And I know Jason's also mentioning things that have actually been relevant for me on my personal tax return, even though I'm not a business. But a lot of good information coming your way. Just to say a word or two about SCORE. This is a SCORE webinar. I'm a SCORE mentor. SCORE is a chapter of volunteers. We're a resource partner for the SBA, and we do mentoring and education for small business. This is part of our education program. The mentoring is free, always free. Again, since the COVID, we're doing that on Zoom. If you can't do Zoom, we're doing it on a phone conference call. To sign up for that, you need to go to our website, indianapolis.score.org, and sign up for that. Love to have you come for a mentoring session. We've had this workshop for a number of years, and it's one of our highest rated workshops. It works very well in December about this time because you still have a chance to maybe do a few things that could affect your taxable income, but you want to do everything to get properly ready to pay your taxes in the spring. So today's webinar is an hour and a half. The presentation will definitely fit inside that box. If we go a little bit over on an answer, that's okay too. So as mentioned, we'll read it. The slides will be available afterwards. You'll get an email with the link to the recording and the slides. It comes about 4 or 5 days afterwards. We have to take the video and edit it at the beginning to the right starting spot, and then we have to post it on our YouTube channel. But we're ready to go. So Jason, I'm going to turn it over to you. You've got your slides up, and I'm going to sit back and watch the questions come in. You can use the Q&A function. I'm going to try to gather those up, and then Jason and I'll talk about those at the end, most likely. So, awesome. Jason, it's yours.
Thank you, Bill. Thank you. Appreciate all the kind words and everything. And ladies and gentlemen, thanks for spending some time with us this afternoon. One of the things I always joke about, I've got the biggest challenge to try to make sure that hour and a half is not only entertaining but informative, because taxes is probably not the most exciting topic you can go over. But today we're going to talk about some tax tips for small businesses. As we get into, we're going to cover, these are the areas we're going to cover today through our slides and through our presentation. We're going to talk about business organization. That's exactly how your business is organized, LLC, corp, etc. We'll talk about some income and expense recognition. We'll talk about depreciation, and I will tell you, when it comes to taxes, depreciation is our friend. We'll talk about some payroll issues that are kind of on the horizon with the Internal Revenue Service and small business owners. And then we'll go through some business and individual tax planning strategies. I often get the question, why would we include any individual tax planning strategies in a small business seminar? Well, as a small business, it's very likely that your business passes through that income to you. And we'll go through that as we're going into our next slide of business organization. So first, let's talk about our three main concerns when it comes to taxes and entity type. We're going to discuss legal liability, the tax implications, and then some of the formation administrative expenses. Now, as a sole proprietor, and a sole proprietor means you have not filed any documentation with the Secretary of State of Indiana, you've not formed a corporation, you've not formed a partnership, you haven't formed a limited liability company. As a sole proprietor, you have full legal liability of any activity in your business, and that legal liability could extend over to your personal assets. Your income from that business is going to be subject to income taxes. In addition, it's going to be subject to self-employment taxes. And self-employment is a complete separate tax outside of income taxes. If you are a W-2 employer, have been a W-2 employee in a company, you know that 7.65% in FICA and Medicare are withheld from your paycheck, and your employer pays the other 7.65% on your behalf to the Social Security Administration and the Department of Treasury. Well, as a sole proprietor, your income from that business is going to be subject to both sides of that tax. Now, a sole proprietor, it's very easy formation and there's very low administrative expenses. You absolutely are entitled to, in this country, to go and just hang a shingle and say, hey, I can do this and I will charge you this to do it. And you now are a sole proprietor. A limited liability company is probably one of the most common next steps people take. This concerns filing articles of organization with the Secretary of State. Now, this is going to give you what's called limited personal liability. You may still have some liability with your unpaid bills, unpaid loans, maybe some legal issues, but those are going to be kept inside of the limited liability company. So any bad judgments, any torts, any claims are not going to extend over to your personal assets. You have effectively shielded your personal assets from your business assets. You are still going to be subject to income and self-employment taxes, absent of making any special elections. And again, we've got easy formation, low administrative expenses. Most of my clients have been able to file their own LLC articles of organization on the Secretary of State's InBiz website. The cost is about $97.13 with the credit card fee. And it takes about a half hour to an hour to go through and fill out all the documentation, but it will take you through a step-by-step process. A corporation will exempt you as the owner from personal liability. Because corporations are standalone entities under Indiana state law. Now, you have either entity level or pass-through taxation. That means if you're, for instance, a C corporation, then that C corporation is going to pay taxes on the net income, period. That's the way it works. Now, if you file an election with the Internal Revenue Service and you say, I want to be treated as an S corporation, now the S corporation does have to file taxes, but it does not pay taxes. The income from that S corporation passes through to you individually, and then the income taxes are calculated on your personal tax return. There are some record keeping and tax preparation expenses you're going to run into if you form a corporation. Not only the articles of incorporation, but you're supposed to keep board minutes and meeting minutes. You're going to have separate tax returns that have to be filed as well. One of our last entities we talk about is called a partnership. In a partnership, all of the partners that are considered partners in the partnership, they share liability. Partners also get to share in the profits and losses. Now, there are going to be some administrative expenses on this entity as well. You're going to have to keep good records. You should be having regular partner meetings. You should have a partnership agreement that specifically spells out who's in charge of what, who the manager is, who's doing the day-to-day operations, if there's any guaranteed payment for the partners, for the use of funds or any kind of pay. And in a partnership, I can tell you that by default, the income passes through to you as a partner. That income is reported on your personal income tax return, and you are subject to both income and self-employment taxes. So the tax bill can get up there depending on the level of income. We're going to move right along here into our second section. This is normally the longest section of the presentation. This is where we're going to get into income and expense recognition. Now, when you are a small business owner, one of the things that you have to decide when you first start out is what is going to be your method of accounting. And that simply is, how do you account for your income and how do you account for your expenses? Right now, for most small business owners, there are two methods available. There's the cash or there is the accrual. Well, the cash method of accounting is fairly simple. You record your income when it's received. you do not have to record any receivables. Now, receivable means you've provided a service or sold a product to someone, they haven't paid for you. You get to the end of your reporting period, typically 12/31 or the end of the year, you haven't been paid. Well, under the cash method, you don't have to include that income. Even though it's due to you, you do not have to include it in your income. But you also have the flip side when it comes to expenses. You only record expenses when you've paid them. You do not carry accounts payables on your books. They do not count as expenses until you have actually written the check, paid in cash, or used a credit card to pay that particular vendor bill. Now, under the accrual method of accounting, it's completely different. Most large businesses use the accrual method of accounting. You record income when it is earned, and you do have to track accounts receivable. Now, in contrast to the cash method, just because you're not under the cash method, just because you're not recording income when it's received, doesn't mean you don't track who owes you money. You just don't have to account it for in your reporting. Same thing here in accrual method. When you get to your end of your reporting period, December 31st, end of year, typically for small businesses, you have to go and count up who owes you money. Who did you deliver the product to? Who did you provide that service to? And who owes you money? And you know that it's due to you and you have a legal right to receive it. You're just waiting on your customer to pay you. You have to report that in your income. On the flip side, the same also goes for expenses. You look at, when you get to your end of your reporting period, you're going to look and say, I've purchased these items, whether it's supplies, goods, other goods and services from other individuals. I have received these goods and services, yet I have not paid for them. Well, you're going to record those accounts payable, and you get to deduct them in this year. Now, one of the most interesting things to note is when the Tax Cuts and Jobs Act of 2018, that was the first major tax legislation, was passed a couple of years ago by President Trump in Congress once he got into office. That tax law actually increased the threshold for small businesses in order to use the cash method of accounting. They raised it to $25 million. So yes, the government considers you a small business if your gross revenues, your total income generated, is less than $25 million. And if that's the case, then you by default can choose the cash method of accounting. No special elections made. When you file your first tax return, you tell them, hey, I want to be on the cash method of accounting, and it's done. And you're on that method until you elect down the road to change it. At our firm, we recommend to our small business owners to use the cash method. It only makes sense from a cash flow perspective. Moving on, getting into some of the different types of expenses. Under U.S. Code 26 of the U.S. Code, Title 26 of U.S. Code is where all your tax laws are going to be held. And in Section 162, specifically 162 subparagraph A, in general, it tells you that you are allowed a deduction any ordinary and necessary expenses paid or incurred during the taxable year when you're carrying on your trade or business. Now, we have to get into what means ordinary and necessary. So I'm going to go through what I consider to be a fairly extensive list of the different types of expenses that you can have in a business. For instance, advertising and marketing. Very common in small businesses. You may pay for some Facebook advertising. You may be paid for some of those in-text banners. You may do some web advertising. Any payments to put your business name and your contact information in any kind of periodical, in any type of social media, those are advertising and marketing fees, expenses, and they are fully deductible. They're ordinary and necessary to run a small business. Commissions and fees. Commissions and fees can often be commissions that you pay to someone for the services they've rendered for you. A commission that you may pay to a salesman. You may give a fee, a finder's fee, to someone who refers you business. Those are ordinary and necessary and deductible. Now, communications is a general account we use. It can cover everything from telephone, your cell phone, your fax line, and even your internet service provider fees. We encourage our clients that if you're working from home or working in a shop and you're paying for an internet connection and you're using that internet connection to conduct your business, such as sending invoice to clients, accepting orders, emailing customers back and forth, then you can deduct the cost of that internet service provider. Contract labor. This is a topic we'll address later in the payroll section of some specifics about contract labor. But contract labor is where you've hired someone who is independent of your company. They're outside of your company and you've asked them to do something for you, such as you've hired a repairman to come in and make some fixes to the roof of your shop. You've asked someone to repair the copier in your office. Contract labor is always deductible in full. Insurance can be a large deduction for small businesses. One of the things we find out is when we start working with small businesses, they don't have enough insurance. When we talk about insurance, we're talking about insurance that covers the loss of your assets, losses of income, or it's insurance that could defend you in any type of business lawsuit that could arise because you have maybe a disgruntled employee or a disgruntled customer. So we tell all of our clients, reach out to your insurance agent, ask them about what's called E&O liability insurance, errors and omission, any kind of liability insurance policy. They are affordable. They are fully deductible as a business expense, and they're going to give you some peace of mind, and they're going to be there to back you up in your business in case you ever lose revenue due to a disaster, due to a fire, due to water damage in an office. They could help you defend yourself in a defamatory type of lawsuit or any type of tort liability. The next item on our list here is interest paid. Interest, obviously, is the cost of borrowing money. So if you're using a credit card for your business and you do not pay the balance full at the end of the month, it's going to incur interest on the next statement. Well, if all the expenditures on that card are business expenses, then that interest is also deductible. Same thing goes with borrowing money from a bank. You borrow money to purchase a business asset, such as a truck, copier, other equipment. The interest paid on that loan is deductible because that is a cost of the borrowing the money. Lines of credit, same difference. You use a line of credit to help operate your small business cash flow. The interest paid is also going to be deductible. Some of the other items that you might encounter in your small business are professional services. The cost of your business attorney, your accountant, me, those types of things are absolutely deductible under ordinary and necessary rules. Rent or lease, that covers both equipment and space. If you rent a storage space, a place to store product and supplies, well, then the cost of that rental space is also deductible. Cost of the office you work in, any leased equipment, those costs are fully deductible. Repairs and maintenance. Now, repairs and maintenance is generally limited to a repair and maintenance on a business asset or something that you use in your business. For example, you have a cell phone. If you need a new screen and you have it repaired, well, if you use that cell phone and the company is paying for the cell phone bill, then the repair of that screen would absolutely be deductible. Repairs to computer equipment is common. Repairs to office space, absolutely common. Those would be fully deductible as well. Supplies is usually a general category we use for a lot of different things. That can mean office supplies, shop supplies, small tools if you're some sort of mechanic or operating in a contract business. Supplies that you might use in your business, purchases of wood to repair things if you're a contractor. All those different types usually fall into the supplies. When it comes to supplies, I usually tell my clients, if you spend money during the year and you're ultimately really unsure of whether or not it's deductible, keep the receipt. Pay it out of business funds, keep the receipt, stick it in a folder. Meet with your accountant. You should be meeting with your accountant periodically, not just at tax time, because tax planning, as we'll discuss later, is key to a successful operation of a small business. But keep that receipt. If you're unsure, ask. Hey, I purchased this and this is how I'm going to use it in the business. Is this deductible? We get those questions constantly from our clients, and we encourage them to email us to ask those questions. We'd rather have them ask the questions, get clarification, and know that the money they spent was deductible or not deductible, and tell them why. That way they can learn not to purchase that or a different way to purchase it and use it to make it deductible in their business later. Taxes and licenses. Now, your income taxes that you pay personally are never deductible as a business expense. When we refer to taxes in a business, usually we're referring to two different, maybe three different types of taxes. One is payroll taxes. If you hire someone, you've got to pay FICA and Medicare on behalf of that employee, and that gets remitted to the government. That's deductible as a business expense. Personal property taxes. If you have a lot of equipment, the state of Indiana requires you, whether you have equipment or not, they require you to follow a Form 103 and 104, which is called a business tangible personal property tax return. I know, mouthful. In our office, we just call them PPTs, personal property taxes. Now, if you have less than $40,000 in total equipment, you don't have to pay taxes. You've just got to file the exemption form and tell your county assessor, hey, I'm not subject to these taxes. But if you do have more than 40,000, they're going to send you a bill in May and November every year based on that assessment. That property tax is deductible. If you use vehicles in your business, or your business owns vehicles, trucks, cars, vans, etc., the plates that you buy or purchase through the BMV for those vehicles, that's a form of a tax. That's an ad valorem tax. It's a tax based on the value of that vehicle. That's also deductible. Licenses. If you're a hairdresser and you go out and get the special license to do, shaving of men, beards, heads, all that thing, cosmetology license, veterinary license, any kind of license that's required by a state or a city or a local authority for you to conduct your business, absolute 100% deductible is an ordinary and necessary expense. Now, travel and lodging can get a little hairy. Anytime you're doing any traveling for business, those costs are going to be deductible. For instance, you're going to a conference in Atlanta, and that conference is directly related to your industry. You're going to learn how to do different things in your profession. You're going to learn how to do things in your industry, how to generate more revenue. Then your travel to that conference, the cost of the conference, and the cost of the lodging while you're staying at that conference, absolutely deductible. Usually most of the questions we get are, well, my family decided we're going to take a little trip up to, let's say, Michigan. And while we're there, I'm going to go and I'm going to call on a couple of customers. Can I now deduct the entire trip for the whole family? The short answer is no, but there are ways to take advantage of these different types of trips. For instance, the days you're there that you are calling on customers and your primary purpose is conducting business, then yes, the cost of those days is going to become a travel expense. The other days where you are on vacation, where you've taken your family, where you're relaxing and not conducting business, then those days are not going to be deductible for tax purposes. But there's some really great ways to do vacation and get some tax benefits out of it by conducting business while you're out on that vacation. Utilities, pretty general category here. If you have an office space and you're paying electric, water, sewer bills for the operation of your office, then those are going to be fully deductible on your taxes.
Hey, Jason.
Yes.
Question with respect to all of the expenses for the vehicle, like the plates and everything else, actually. Does that vehicle have to be actually registered to the business or not?
No, the vehicle does not have to be registered in the business name. Sometimes you can run into some hurdles at BMV when it comes to trying to title a vehicle in a business name. When it comes to the Internal Revenue Service regulations, all of the regulations that surround depreciation, costs of operating a vehicle, gas plates, insurance, et cetera, is all based on business use, which is something I think we actually address in this section a little bit later. So no, it doesn't have to be titled in the company. Does it help? It could in an audit, in an audit with the Internal Revenue Service, but no, it all gets down to how you're using that asset in your business. And if you get audited by the Internal Revenue Service, it's, can you prove that the expenses you've incurred for that vehicle were used in the business? Health insurance. It's another big expense nowadays. Your health insurance costs as a small business owner are deductible against your income, your ordinary income, If you have net profit from self-employment, which means maybe you're a sole proprietor filling a Schedule C on your 1040 on your individual tax return. If you're a partner in an LLC, a multi-member LLC or a partnership, or if you're a shareholder of an S corporation, you can deduct the cost of that health insurance against your ordinary income. All of these different types fall under the self-employed health insurance rules. So it's very important that if you do have out-of-pocket health insurance costs, we're talking the actual premiums, the monthly premiums for medical, dental, and vision insurance are deductible against your ordinary income. Now we get into some of the automobile expenses, the automobile mileage. There's two ways to account for a vehicle in your business. You can use the standard mileage deduction, which is probably the most common, and it's probably one of the most efficient ways. All you have to do is be able to have a log of the miles you've driven for business. That log should have the date and the purpose of the trip, and obviously the total miles you drove. And as long as you keep a good log, you hand that over to your accountant at the end of the year, and they're going to show you how to turn that mileage log into a tax deduction. For 2020, for this year, this tax year, the reimbursement rate or the deduction rate is 57.5 cents a mile. That's pretty good. For instance, if you happen to drive, if you do a lot of sales or do a lot of customer driving, and you go and you drive 10,000 miles this year, well, that's going to generate a $5,750 deduction on your tax return. Now, if you are an S corporation or a partnership, there are some other hoops you have to jump through. For instance, the S corporation needs to reimburse you as the owner for those miles. Same thing on a partnership. You should be tracking your miles, submitting some sort of expense report to the business, and having it reimbursing you. It's more important in an S corp. In a partnership, if it's just you and your friend, your business partner, and you're driving, but you're not reimbursing, you do not have a policy to reimburse those miles, you could track those miles, deduct it against your income on your personal tax return where that partnership income is being reported. And then let me go back and address this. Goes back to those vehicle expenses that was asked. One of the things you can do, and this is part of the tax planning side of the business, if you've kept that that mileage log, and if you use that vehicle enough in business, usually, and actually under the listed property rules, it's more than 50%. So you use that vehicle more than 50%, then the company can pay for the gas, the insurance, the repairs and maintenance on that vehicle. They can pay for the lease payments if it's a lease, and you can deduct the interest on the loan if it's a financed vehicle. Now, the deduction is going to be limited to what we call the business use percentage. This is why it doesn't matter whether the vehicle is actually registered in a business name, but you still have to keep a mileage log. And normally what we do with a lot of our clients is they'll pick up the phone and say, hey, Jason, thinking about we need a new vehicle. What do we do? And usually my first question is, what type of vehicle and how much are you going to use it in business? Because that's always going to need to be known before I even answer the question. And if they say we're going to use it 75% in business and it's going to be a big, huge, heavy duty truck, maybe it's a contractor, farmer, etc. Well, in that case, I might say, you know what? It's better to buy it. Buy the truck, because now the expenses, the deductions with depreciation, fuel, insurance, repairs and maintenance are going to be greater than doing this 57.5 cents a mile, maybe if you're only going to drive it 5 to 7,000 miles. But here's where you get to work with your accountant and determine what's the best course of action. I'm going to get a vehicle regardless. Which way is going to give me the best tax advantages? So reach out to your accountant and discuss those. Get those facts together and discuss it with your accountant to make sure you make an informed decision when it comes to vehicle expenses. Now, meals, and notice that and entertainment is crossed out. Well, under the Tax Cuts and Jobs Act of 2018, entertainment was removed from the tax code. Now, entertainment means some sort of recreational activity. For instance, if you buy tickets to go to a Pacers game and you take a customer, the cost of that ticket is no longer deductible as a business expense. The IRS, Congress, in fact, with IRS enforcement, have completely pulled entertainment out of the code. Now, meals are still deductible. The meal must involve your business. That means you've either talked business during that meal, or that meal occurred directly before or after a business meeting. It's got to be related to your business purpose. It must be documented thoroughly. Most of our clients, if they have an issue with their meals and that deduction, is they don't have the receipts. The IRS rules for substantiation of meals is very clear. You've got to be able to show when the expenditure occurred, where it occurred. You should be able to document what the business purpose was of that meal, either who was with you and even what was discussed. Now, I have a lot of clients, or I have had a lot of clients that will say, well, my old CPA or my attorney said, just keep my credit card statements. That's enough. Unfortunately, it's not. I've had some clients who have come on board new with us, and we told them credit card statements are not enough. And lo and behold, a previous year, one that we didn't help them, gets audited, and the IRS will tell you that the credit card statement is not enough alone to substantiate. It gives you the location and the date and the amount, but it's not going to give you that business purpose. So you're going to need to document that somehow. Here's what I do for my clients. If you go out and you go to a meal with a customer, with an employee, with your business partner, prospective employee, prospective client, customer, just keep that receipt. You fill in the tip, you sign it, you send the one to the restaurant, keep the other one, flip it over, and before you even leave the table, just jot down who the meal was with and what you discussed. That's all you got to do. Stick it in a folder. You've got it. Obviously, if you're bookkeeper or if you're doing your own books, you're going to pick up the expense, but you're going to want that documentation in your files in case you're ever audited. And the deduction of meals is always limited to 50% of the expense. For example, you go out and you have a nice dinner with a customer, and with the tip, it costs you $100. Well, when it comes tax time, the deduction on the tax return is only going to be $50. We have to limit that expense from $100 down to $50. The home office deduction. Get this a lot. If you are a sole proprietor or an LLC and you're filing a Schedule C with your business, you can get what's called a home office deduction if you work out of your house. Now, to qualify this, IRS rule said that it has to have regular and exclusive use. For instance, you must regularly use part of your home exclusive for your business. That does not mean you necessarily have to have customers come in there, because sometimes you may not only customers in your house, but you have that home office. That's where your desk is. That's where you keep all your records. That's where you're doing all your emails. That's where you're contacting your customers, keeping your books, doing everything, making sure that you keep most of personal activity out of that room. And it's your principal place of your business. If you do not have an office somewhere else, then your home office is going to be your principal place of your business. You can qualify for the home office deduction. Now, there's two ways to calculate the home office deduction. The old or regular method was a percentage of your expenses, and we used a square foot calculation. So what you'd have to do is know the total square foot of your home office and the total square foot of your home. Now, you divide those two and you come up with a percentage. For example, you have a 10 by 10 home office and a 2,000 square foot home. So you've got 100 square foot in a 2,000 square foot home. That's 5%. So now you're able to take 5% of your mortgage interest, real estate taxes, your utilities, your insurance, all of those costs that you've paid for on your home. That's the regular method. Now, the regular method can be painstaking. You have to keep all those utility bills. You have to keep the insurance bill. You have to keep all those documents in your tax records for a minimum amount of time in case you ever get audited. Now, there is a simplified method. The simplified method was adopted 5 or 6 years ago. Basically, the IRS did a study and came out and said, hey, you know what? We know the home office deduction can be complicated, but we want to make sure we get, we want to make sure that we give some taxpayers a deduction without any pain. So now you can get $5 per square foot in your home office. There's no documentation required other than being able to prove how big your home office is and that it is used regularly, for business. And I will tell you, if you get audited by the IRS, if you claim the home office deduction, they do have the right to show up at your house and inspect the home office. The maximum deduction is $1,500. So 300 square foot home office, you're going to max it out at 1,500. I know there's some questions. We're going to save those till the end, but let's move on through depreciation. Now, this is our next section. And remember, I said depreciation is our friend when it comes to taxes. Depreciation is a reduction in the value of an asset with the passage of time, due in particular to wear and tear. For example, if you go and you buy a computer, you pay $1,000 for a beautiful laptop, powerful one. Well, 3 years later, it's not so powerful. It's got a lot of junk on it, and it's not worth $1,000. So the rules in Code Section 263 talk about giving deductions for businesses for the purchase of this type of long-term assets. It's an income tax deduction that allows a taxpayer to recover the cost or other basis of certain property. Now, it applies to property that you own that is used in business or held to produce income. It has to have a determinable useful life that lasts more than 1 year. For example, you go to Staples and you buy a bunch of pens. While it may last more than a year if you don't do it, this doesn't have a more than 1 year useful life as far as the Internal Revenue Code. This is an office supply. You're done with it. And computers are different. They do have a determinable useful life that's more than 1 year, and it must be used in business or held to produce income. And when we mean held to produce income, if you own real estate, for example, a rental property, you're producing income with that asset. You own it, you're holding it, you're producing rental income. You can take depreciation on the cost of that asset. Now, since 1986, the standard system for calculating depreciation for a business is called MACRS. And that is an acronym that stands for Modified Accelerated Cost Recovery System. Now, under this particular system, the standard useful life, which is what determines how we're going to calculate that annual depreciation deduction, the common lives are 3, 5, 7, 10, 15, 20, and 25 years. Now, I can tell you, as a practicing CPA with over 20 years experience, I've never used the 20 and 25 years. Most of the equipment or most of the useful lives that we apply to our clients when they're purchasing equipment is 3, 5, and 7. And then we have residential and non-residential property. 3 applies to computers and their peripherals. 5 is like standard office equipment, telephones, calculators, an office copier. 7 is usually what they call furniture and fixtures. So desks, filing cabinets, office chairs, those items are depreciated over 7 years. Now you see a residential rental property. And when we see residential rental property, it means that's a rental home. It's you own a house and you're renting it to someone. You depreciate that over 27 and a half years. Non-residential, well, another word for that is commercial. You own commercial property, an office building, a strip mall. It's a property that's being leased out by another business, not a tenant, like someone who lives in a house or a condo or an apartment. Well, non-residential real property is depreciated over 39 years. One of the biggest questions that we can get into with depreciation is whenever you repair something, for instance, in a building, or you fix a piece of equipment, you have to determine where that was a repair and maintenance, or was it a capitalized cost? And there have been thousands of court cases and disputes with the Internal Revenue Service over whether one item is a repair, and the IRS says, no, that's a cost that needs to be capitalized. This all falls under Code Section 263A. If you ever get bored, you want to solve insomnia, go ahead, Google 263A and start reading. But The questions that we usually ask when we're trying to determine whether this was a repair and maintenance or if it's a cost that has to be capitalized is, are you fixing the asset so it will work again? Or are you extending its useful life, and are you expanding its use? I try to use an example. You have a copier that you purchased from, I don't know, Gordon Flesh, and you paid for it outright. It's your equipment. And after 2 years, it goes down. You got to call the repairman. He comes in, he puts a new drum on it, maybe a new toner, gidget, whack-a-mole, whatever you want to call it. That's a repair, because all you're doing is getting that asset back into an operating condition. You've not really extended its use, its useful life. That copier is still going to probably last the same amount of time they told you. Now, what about extending its useful life or expanding its use? Usually you're talking about very large capital expenditures. For instance, you own a commercial building and you get a new roof. Well, a new roof, the IRS has stated multiple times, you're putting on a new roof. You're taking off an old one. You're putting on a new one. So you're extending the useful life of those items that you put on the roof of the building. That's going to be capital cost that you're going to have to capitalize and depreciate over time. Now, here's where small businesses get a lot of benefits in these complicated sections of the code. About 6 years ago, the IRS passed some final regulations under Code Section 263. Specifically, they went into the regulations, they changed out 1.263 A-1F. Well, this is great for small business owners. That section of the code basically says if you have an invoiced item, copier, computer, furniture, whatever it is, and that individual invoiced item is less than $2,500, you can actually attach an election to your tax return. It's called the de minimis safe harbor election. And you just get to expense that item. You don't have to track it for depreciation purposes. You don't have to apply MACRs to it. You don't have to apply any of the other sections that we'll talk about. You just get to expense it right on your income statement down in the bottom. I have several clients that will actually set up an account and call it de minimis equipment. And whenever they make a purchase of a computer, a tool, a piece of equipment, anything that costs less than $2,500, they just expense it right into that account. That way we see it as accountants. We know they're applying the safe harbor policy, and then we know to make that election on the tax return every year. So keep in mind, as a small business owner, items that cost $2,500 or less, forget about it. Don't have to depreciate them. You can just expense them. One of the most common types of depreciation deductions that's been around for years is called the Section 179 deduction. You may have heard of it before, but what it enables you is to write off 100% of the cost of a piece of equipment. Now, don't confuse this with the $2,500 item. This also applies to larger items that cost more than $2,500. There are a couple of catches. One, the business must be profitable. Throw some numbers out there. If you look at your income statement and your net income was $25,000, not including this big piece of equipment you bought that cost you $15,000, you can apply Code Section 179. You can write off that $15,000. That brings your taxable income down to $10,000. Easy peasy. But what if your net income was $10,000 and the cost of equipment was a big one? You financed it over 4 or 5 years and it cost you $25,000. Well, you're limited to $10,000 under Code Section 179 because it says that any kind of Section 179 deduction cannot take you into a loss situation. So you can only take 179 down to your income is zero. Now, the good thing is that the non-deductible portion, for instance, that 25,000, you took 10 under Section 169 or 179, then the remaining 15,000 that you didn't get to deduct carries over to the next year. If the next year you're profitable, you get to take that 179 the next year against that taxable income. Now, let's talk about Code Section 168K. Absolutely my favorite section of the tax code when it comes to deductions. This is called bonus depreciation. The code says simply, you do not have to be profitable. You can write off 100% as depreciation the cost of an asset you put into place. There are some income limits, but as long as you're a small business with less than 25 million in gross revenue, this applies to you. You write off 100% of every fixed asset you buy. Now, this was a big change. We've had bonus depreciation in different forms over the years, 30%, 50%. Then they kicked in 100, then they took it back out and went down to 50 again. But it's in there and it's permanent right now. Code section 168K. Congress's intent of expanding 168K to 100% was to really show small business owners, hey, we want you to report your income and expenses on a cash basis. So if you go out and you buy a $5,000 copier, we want you to just write off that $5,000 copier. Do it under 179. Do it under code section 168K. If it's less than 2,500, do it over here. Congress was actually trying to simplify. They call it simplification. It's not. Now you got 3 different sections of the tax code. But what they're trying to do is to help you as a small business owner mirror up the cash expenditures you're making for equipment with your taxable income. And I was fully supportive of this. I think 168K is a great section of the code that's going to allow you to really deduct a lot of additional expenses before year end.
Jason?
Sure.
Before we go on to payroll, harking back to the home office, and I have multiple questions on this. Not a lot of people are working from home, so they have home offices where they used to go into a real office. Are they affected in any way? Do they get any tax benefit from working at home?
Yes and no. And here's why I say yes and no. If you're a small business owner and yes, you had an office, you had a shop, but because of the quarantine, you as the owner were forced to send everybody home, close shop, go work from home, and you still continue to work from home. I do think because of the quarantine that if you're self-employed or a small business owner, you are entitled to some sort of deduction for that home office during the quarantine. And yes, I think it can be prorated for the time. Now, I think the issue you're going to run into is the IRS is going to say, hey, that deduction is going to be limited to the time where you were forced. This is not voluntary. We're talking about forced. So when Governor Holcomb, passed his executive order and forced people to go work from home unless they were considered an essential business, it had to be a forced closure in order to qualify for the deduction. Absolutely. On the flip side, though, if you're a W-2 employee for another company and you were forced to work from home just because your boss sent you home, you're not going to get a deduction for that home office deduction, whether you were forced to or not. That's considered an unreimbursed business expense. Unreimbursed business expenses used to report them on Form 2106. It showed up on your Schedule A as an itemized deduction as long as it was more than 2% of your adjusted gross income. That section of the code was eliminated with the Tax Cuts and Jobs Act of 2018. So if you're an employee working from home, sorry, you're not going to get a deduction unless the IRS comes out and issues any special guidance or does any special relief provisions because of the pandemic. As of today, to my knowledge, there has been none that have addressed anything as far as the home office. Now, like I said, if you are the business owner, the sole proprietor, partner in a partnership, et cetera, then yes, I think if were not considered an essential business and you were forced to work from home, I think there is a small deduction that's out there. And bring that up with your accountant and investigate it, because I think there is something out there for you.
Jason, one more thing about that. We're calling it a home office deduction. What about people who are renters? It's not their home. They're in an apartment or something.
Absolutely. Absolutely. If you have an office and you're rented apartment or condo, you can still qualify for the home office deduction. Now, you still have to have a secluded area. You have to have that set aside office. It can't just be like a table in your kitchen or a corner desk in your bedroom. It does have to be an office that is, and remember, we have to go back to the rules, still used for your principal place of business and exclusively used for your business. But if you do qualify under those rules, then yeah, instead of deducting mortgage interest and real estate taxes, what goes into that calculation are the utilities, maybe your renter's insurance, and the rent. You get to apply that percentage or take that $5 square foot percentage deduction. You don't have to own a home. You just have to have an outlay of costs for where you live.
Okay, one more thing before you get rolling here, and you can slip this in wherever you want, but there's some people who got some money from the government that they didn't have to pay back because of COVID. When it's appropriate, just talk about the tax effects or not tax effects of that transaction.
You know what? I'm going to tackle it now because I'm still about 3 minutes ahead of where I think I need to be as far as my slides are concerned. So I'll jump on this because there's been a lot out there. There were 3 general types of relief that came with the pandemic. You had PPP loans, you had economic injury disaster loans, and then you may have gotten some grants from like the city of Indianapolis, small city grant, Chamber of Commerce. Now, the way the code reads right now, if you're a for-profit business and you receive grant income from another agency, whether it's a government agency or not, that money is included in your gross income. So you've got to put that in your gross revenue. Right now, economic injury disaster loans, there's a lot of money that came out, and those had what's called an advance grant of money. Well, that little advance grant, that $1,000 per employee that you may have had and applied for, that advance grant is specially, there were special instructions that said the advance grant is not taxable. So that you're okay. So if you had 3 employees, you applied for an EIDL loan, you got $3,000. Whether you got the loan or not, you got that $3,000. Under the Small Business Administration guidelines, that advance grant's not taxable. Now, one of the biggest problems we're having right now are those who applied for and received PPP loans, the Paycheck Protection Program loans. That was a part of the CARES Act. When Congress passed the CARES Act, they sent a bunch of money out. Now, soon as the first round of PPP loans was completed in late May, the IRS issued some guidance, and they referred you over to Code Sections 162, 163, and 265. Those sections of the code address business expenses, interest expense, and tax-exempt income. Because as you recall, you took a PPP loan, you spent it on qualified payroll, rent, utilities, and other operating costs per the guidance. If you did that, submitted an application, it would be forgiven. You didn't have to pay it back. Well, IRS issued guidance and said, hey, you got to remember, if you have loan forgiveness, that's income. That's tax-exempt income. And Code Section 265 says, any expenditures you made, any deductions you may have that caused that loan to be forgiven and non-taxable, those deductions are non-deductible. So in a nutshell, the question is, do I have to pay taxes on my PPP loan? No, you're not paying taxes on the loan, but you're having to reduce your expenses, which has the exact same effect. It increases your income by the amount of your PPP loan that was forgiven. So the number, you're paying on that loan amount. Now, Congress, as soon as that guidance was issued, Congress stood up and said, whoa, time out. That was not our intent. That's not what we wanted. And the IRS, rightfully so, said, great, we're just the enforcers of law. Go fix your law. So what we're waiting on right now is for Congress to do what's called a technical correction. And all they need to do is go in and add some language to the CARES Act that specifically says any of the deductions incurred by a recipient of PPP loan funds in an order applied for and to gain forgiveness. In order to apply and gain forgiveness, those deductions are still deductible, and Code Section 265 does not apply. So that's where we're standing right now. And I can tell you as a CPA, it's been tough doing tax planning this month, because I may have a client who had close to nothing as far as income is concerned, but has a PPP loan of $250,000. So now I'm doing a tax projection that says, well, here's what your taxes are if Congress does a technical correction. Here's what your taxes are if they don't. So we're having to do some dual planning. Now the AICPA, the American Institute of Certified Public Accountants, made a statement that they really do believe, and I do believe this as well, that Congress will eventually do the technical correction and you won't have to pay any taxes on your PPP loan. But we don't know when that's going to occur. We're hoping the technical correction is done before Congress goes home for the holidays, but that's in about 2 weeks. If not, we hope it's done in early January when they come back from the holidays before we start filing tax business returns, because that would be a great thing. So hope I addressed that. If you got any more questions at the end, we'll tackle it, because I sat in a lot of continuing education myself to learn more about this. So let's move on to payroll. So one of the biggest questions we get from our clients is, do I have an employee or do I have an independent contractor? Well, there are some questions you have to ask. Does the business or does the employer control how and when the work is performed? Does the business employer control how and when the person is paid and what expenses, if any, are reimbursed? For example, your typical independent contractor is a contractor. You hire someone to fix your roof. That's a contractor. They're usually saying, well, here's when we're going to come, here's what we're going to do, here's how much it's going to cost, and you're paying them. That's a contractor. It's not an employee. But if you get someone in your office and you're saying, okay, I need you to come 8 o'clock on Mondays, 9 o'clock on Tuesdays, 8 o'clock on Wednesdays, take off Thursday and Friday. And when they get there, you say, this is what I need you to do. I need to have it done by this time. And you're supplying their computer or giving them guidance on how to do that job. That's going to be an employee. Based on some recent court cases and a lot of activity, the IRS is really starting to make this a focus in audits. And I'll tell you why. They're finding out that small businesses, if they have it's easier for them to treat someone as a contractor. Why? Because you don't have payroll taxes, which we'll talk about. Saves the company money. So the IRS is really starting to investigate these different types of relationships. Some of the other questions you're going to have to ask: does the individual own a separate business and perform the tasks under that business name? Does the relationship have a start and an end date, or is it an ongoing set of changing tasks? These are all the questions that the IRS is going to ask of you if you get audited and you try to say that this person was an independent contractor. Here's an example of employees: administrative assistant, skilled technician, a salesperson, a manager. Those are employees. If you hire those different types of people, you're going to put them on payroll. So what are the tax filing requirements? And it's very important to understand the tax filing requirements if you hire an employee. Because number one, you want to capture all the expenses associated with an employee and payroll taxes, but you want to stay on the good side of the federal government and the Indiana Department of Revenue when it comes to filing. In the state of Indiana, you have monthly withholding returns that have to be filed. They're called WH-1s. You have to file those whether you have any employees or not once you apply for and receive a withholding account number. So keep that in mind. You get that withholding account open, you have no payroll, still got to file that return. If not, you get a nasty gram from the Indiana Department of Revenue. Quarterly payroll tax returns. Well, there's two major ones. There's a 941, which is where you report and pay the withholdings that you did on an employee's paycheck. For instance, the federal income tax withheld, the FICA and Medicare. It's also where you calculate your employer portion of FICA and Medicare to remit to the government. The other second quarterly return is called a UC1. That is an unemployment tax. That's your SUI, state unemployment insurance. Sometimes it's referred to SUTA. That's paid to the Indiana Department of Workforce Development. You file those online. You fill an online UC1. They're no longer accepting paper returns. And you pay approximately, for new businesses, the opening rate's 2.5% on the first $9,500 that you pay to an individual. Once their pay has gone above and beyond that, you don't have to pay anymore. Now, there are some annual payroll returns that have to be done when you have employees. You have to file the WH-3, which is a reconciliation of all the WH-1s you filed every year. There's a 940. This is your annual federal unemployment tax. And then you have to file the W-2s and the W-3s. W-2 is the form you hand to your employees, tell them how much they got paid and what their withholdings were, and all the taxes that were applied. The W-3 also goes to the Social Security Administration, along with a copy of the W-2s you filed. Now, here's an example of an independent contractor: your attorney, an accountant, a repairman you hired to fill a roof, a hairstylist. Those are people that you're just going for a service or a product. and they don't work for you on a constant basis. You're going to them for one event, one different type of, at different times during the year. Those are independent contractors. Now, if you have contractors you use in your business, there are some specific rules, and the IRS has gotten a lot more complicated on this one. You have to file what's called a 1099 MISH. This is for miscellaneous income. Well, you're supposed to mail those to the contractor by January 31st of every year, and it's supposed to be filed with the IRS by February 28th. There are some severe penalties if you do not file 1099s. The biggest question I usually get is, well, who do I have to send a 1099 to? Well, let's talk about that. You're supposed to send a 1099 to any contractor, any individual or limited liability company that you paid $600 or more in cash payments during the year. So here's what we tell our clients to do. Let's be smart about this. I want you to, any contractor you're going to hire, they qualify as a contractor, they're not an employee, have them fill out a form W-9. You can Google a W-9, it'll pop right up. You ask them to fill this out. This is going to force them to give you their business name, their business type, the ID number they're using for that business, and to sign off on it. That's your insurance policy for filing 1099s. Because number one, if they're an LLC or an individual, it's going to give you the information you need to complete those 1099s. It's going to tell you name, ID number, and where you need to mail that form to. You put that on the 1099. And then you go into your books, find all the payments you made to that individual or LLC, and you're going to put those in the miscellaneous income form. And you're going to have to send a copy of that to the IRS, and you're going to send one to the recipient. Failure to do these can get pretty nasty. I've heard some horror stories with other CPAs where their clients have disregarded doing 1099s, saying that they didn't want to pay for them, they didn't want to get them done. The IRS came in and audited them, and as a part of their income tax audit, it said, where's all your 1099s? You've got all these contractor payments going out. Why didn't you file 1099s? And the penalties can be $100 per 1099, both sides. That means $100 for not sending it to the contractor and $100 for not filing it with the Internal Revenue Service. If you're going to fill out a tax return and you're going to put contract labor or outside services or any type of line expense like that on there, you should have some 1099s or W-9s to prove that you don't have to file them, because you don't have to send 1099s to corporations. It's not necessary. It's not necessary to send it to partnerships. We're looking for LLCs and individuals. Moving right along.
Hey, Jason.
Sure.
Can you file a 1099 before year end, maybe because you're winding things down or you're done with the contractor, or do they have to go out in January?
No, they don't have to go out in January. You can send them out anytime. I usually just warn clients, it's like, hey, just make sure that the contract is completely done and there's no more payments that need to be sent out to that individual. Because the last thing is you send it out in end of November, early December, and they come back and say, oh, wait a minute, I forgot to charge you for this. And then you end up having to write them another check. You're going to have to amend that 1099. But no, there's nothing against it. Once the 1099s are available, the forms are available, you can fill those out and you can file them anytime you want before February 28th. All right, business tax planning strategies. There's 4 main tax strategy areas we usually cover. We talk about entity selection. We talk about maximizing deductions. We talk about retirement plans, and then we usually talk about estimated taxes. So, moving right along, entity selection. Beginning of this, we talked about sole proprietors. We talked about corporations. We talked about partnerships. Talked about LLCs. Entity selection is very important because it can really drive how much you have to write in checks to the government. Self-employment taxes apply to sole proprietors, partnerships, and LLCs that are taxed as sole proprietors and partnerships. So it's very important to understand that. That way you know, hey, I got to pay some income taxes, but I also have this additional nasty 15% tax that's got to be calculated on top of that. That way you have enough money to pay the taxes when it's time to pay them at the end of the year. There are no self-employment taxes on C corporations, S corporations, or LLCs taxed as corporations. The income from an S corp and an LLC taxed as an S corp flow through to your personal return. And at that return, you only have to pay income taxes. Don't have to pay self-employment taxes on that money. C corporations, as we discussed in the first section, they're a standalone entity. They pay their own tax. Currently, that's 21%. That was dropped from a mix of 35 to 38 or 39 as a part of the Tax Cuts and Jobs Act of 2018. But there's no self-employment taxes. The only employment taxes that apply are going to be on the W-2 wages that you take out as an owner or that you have due on your employees. So it's important to understand the entity you select and how it's going to affect your taxes. And you can make some very, very good informed decisions about how to have your entity taxed. What about maximizing deductions? You know, one of the biggest questions I get from clients is, you know what, I just want to pay less in taxes. Okay, let's look at your record keeping. Let's shore up your record keeping. Maybe it's time you invest in hiring a bookkeeper. Be disciplined about using one account for all of your business income and expenses. Then the bookkeeper, her job's a lot easier to capture all of the income and expenses that's running through your business. What about a credit card? What if you use a credit card in business? Well, can you be disciplined to only use a credit card for business expenses? Well, if you can, you still got to keep the receipts, as we discussed, but now all the income or all the expenses is being reported in one area on one credit card. It's going to make it a lot easier to capture those expenses. One of the biggest problems we'll run into is our client has a business account, they have a business credit card, and then they throw in, oh shoot, I forgot I was out multiple times during the year and I bought a bunch of stuff for my business, but I accidentally used my personal credit card or I used my personal checking account. That's not a problem. But what you need to do is to get into what I call a good business habit of reimbursing yourself for those costs. So if you use a personal credit card or a personal checking account for a legitimate, ordinary, necessary business expense, create a little report. Write it out. What was this for? What was the business purpose? Attach the receipt. Just like you might be an employee submitting an expense report to your employer. Do the same thing. Then reimburse yourself for that expense. Now the money is coming out of the business account, going back into your personal account, and the expense is now in and can be recorded in the books of the business. It's going to make your record keeping life a lot easier, and it's going to make the life of your accountant and bookkeeper a lot easier as well. They'll thank you for it. The other thing is personal versus business use. If you have items that you purchased a long time ago, months ago, weeks ago, years ago, now all of a sudden you're using them in your business. You've converted the use of that item from personal use to business use. You now have a deduction that's available. The question is how? Well, go back to reimbursing yourself for that item. If you still have the original receipt for that iPad or that cell phone or that computer, reimburse yourself for it. Use it in the business. You're using it in the business, get the deduction for it. You can do that. Talk to your accountant and bookkeeper about how to do that. Make sure that if you convert an item that was paid for personally, you now use it in business. Now keep in mind, once you convert it to business use, can't go back and forth, and then say, oh, well, this year I'm going to use it personally. Can't do that. You don't want to do that anyway, because the rules when it comes to taking business assets out of your business can be very complicated. And you get into what I like to call the calculation nightmare of how much you have to pay in taxes on those different items. So that's how we try to address to our clients and show them how to maximize those deductions. Retirement plans. This is some of the greatest things since sliced bread. There's so many different ways for you as a business owner to save on your income taxes and save for your future retirement. One of the most common is a 401k plan. You can do this if you're a sole proprietor. They're called self-employed 401k plans. If you're a small business, a little S corporation, you can do a solo K plan or a single K plan. Sometimes they're called. What if you're an S or a C or a partnership and you have a bunch of employees? It's okay. You can still do a 401k plan. The cost might be a little bit more expensive, but you do a 401k plan. As a participant in that plan, you can put $19,500 away into that plan as a deferral, and then you do not have to pay money on that, any taxes on that money. If you worked in a W-2 job and you've participated in a 401k plan before, you're able to sign up and you get those employee deferrals, and it's just taken right out of your check. It's remitted to the 401k plan. Well, as the small business owner, you can do the same thing. If you're an S corporation, you're going to put yourself on payroll. You're going to pay yourself a wage. You can have some of that money elected to move over and put into that plan. Then you just got to go make the plan deposits. And if you're over 50, we've got this catch-up regulation out there. This allows you to now increase that contribution to $26,000 per year. One of the other different types of plans is called a SEP IRA, Simplified Employer Pension IRA. That's what SEP stands for. SEP IRAs are calculated differently. There are no minimum or dollar amounts as far as the deferral. It's based on 25% of your compensation. And compensation means net self-employed income. If you're a Schedule C or a sole proprietor or an LLC paying taxes, or a partner in a partnership, or if you're an S corp or a C corp, you can take 25% of your W-2 wages and put it away into this. Now there is a max. If you're uber successful and you have a lot of income in 1 year, let's see what that number is. You know, if your taxable income, your self-employment income, or your business income is $228,000, you could put $57,000 into a SEP IRA. And I can tell you, $57,000, assuming a federal and state combined rate of about 25, let's say 30%, it's going to save you over $17,000 in income taxes if you put $57,000 into SEP IRA. The other thing is simples. Simple IRAs are kind of a hybrid between a SEP and a 401k. The simple IRA is sponsored by your business, and you can put away $13,500 into that plan. That's the max, $13,500. If you're over 50, there's a $3,000 catch-up you can do as well. It's a great way to save money on taxes. This is usually one of the first ways I teach my clients on how to save in taxes. Maximize deductions and do a retirement plan. Estimated taxes. Estimated taxes, it's a method of paying the income taxes that are not subject to withholding. For example, you work as an employee, your employer's withholding a bunch of money and they're sending it to the government on your behalf. You don't have to write checks to the Internal Revenue Service or the Department of the Treasury periodic through the year. But if you're a business owner and you're self-employed, nobody's withholding your income taxes. You're supposed to pay estimated income taxes. So individuals, including sole proprietors, partners, and S corporation shareholders might have to pay estimated tax payments. You should be planning on calculating and remitting those taxes. If you don't, you can get smacked with penalties at the end of the year. Now, there's three components of estimated taxes. It goes back to number one, you've got your ordinary income taxes. We all got to pay income taxes on our income. 10, 12, 22, 24, 32, 35, and 37%. Those are the brackets that were established after the passing of the Tax and Cuts Jobs Act of 2018. Then we're going to get into what's called the self-employment side or the payroll tax side. And there's two components, Social Security and Medicare. You'll notice that if you take 12.4%, 2.9%, you add them together, you get 15.3%. Well, guess what? That's your 7.65 times 2. If you're a W-2 employee, you look at the breakdown of your paycheck, you'll notice that you had 6.2% withheld in Social Security and 1.45 in Medicare. Employer kicked in the other half. Well, if you're self-employed and you have to pay taxes, you could be, depending on your business entity, what you've chose, you have to pay the Social Security and Medicare in your estimated taxes as well. By not paying or estimated taxes, can get subject to penalties and have to write a big fat check come February, March. Now, taxes are due quarterly, but as you can see here, the quarters for taxes, for estimated income taxes, are a little different. It's not just every 3 months. For instance, The first quarter, the payments due 15 days after the end of the quarter, 3 months, January, February, March, pay April 15th. But look at the second quarter. It's due June 15th. So you're only paying estimated taxes on your income from April and May. Now the third quarter, due September 15th, we're going to go back to 3 months. Due September 15th. Fourth quarter is due January 15th. You're actually paying income taxes on September, October, November, and December. 4 months. Notice the asterisk that unless that day falls on a weekend or a holiday, then it's due the next business day. Right on schedule. Going to get into our last section. This is the individual tax planning strategies. Had it posed before. Why are we, talking about individual tax planning strategies? Well, like I stated, if you're an LLC, sole proprietor, partner, S corp owner, that business income's ending up on your personal return anyway. There's a lot of ways to reduce income taxes on your personal income tax return. The 5 tax strategy areas, we usually emphasize are family and health, education, job, home and property, and retirement. So when it comes to family and health, let's talk about a couple of things. You've got a dependent care credit. You have children. They need before school, after school care. They're in daycare. As long as both parents work and have earned income, whether it's self-employed or W-2 wages, and you pay out of pocket for this type of expense, you can get a credit on that tax return, 20 to 35%, depending on your income level. That's 20% on the first $3,000 of dollars you spend if you have one child in daycare. That equates $600. If you have 2 children that require any kind of daycare, then the limit goes up to $6,000, and 20% of $6,000 is $1,200. So that you're going to want to make sure when you're doing your taxes or talking to your accountant, hey, you want to make sure you give them this information. Also, if you try to expand your family through adoption, there's a large adoption credit out there for you. Adoptions are not cheap. You end up spending a lot of money out in travel, legal fees, adoption fees, agency fees. If you're going through that process, track them, talk to your accountant. Large adoption credit that's out there. And remember, credits are a dollar for dollar reduction in your taxes. These are not deductions like expenses. This is a dollar for dollar reduction in your taxes. Health savings account. If you have a high deductible health plan, you have an incredible opportunity to participate and open up an HSA account. If your health plan covers your family, you can put $7,100 away into an HSA account, and it is tax deductible. You deposit it in the account, you're going to get the form. It's called a Form 5498. You get to take that $7,100 deduction on your tax return. If your spouse works, they're covered under their plan, but you're a business owner or small or a sole proprietor, and you're paying for your own health insurance. We talked about the health insurance being deductible, but you also can open up an HSA and put $3,550 into that HSA for yourself. And that's an additional deduction against your taxable income. Now, definitions of a high deductible health plan in HDHP. The minimum out of pocket is $2,800 for a family, and the maximum is $13,800. So as long as your health plan falls within those parameters on the out of pocket minimum and maximums, then you can do an HSA and save a bunch. And an HSA is different from a flexible spending account. An HSA, it's your money, you put it in, you don't lose it. It carries over year after year after year. You can build that account up as big as you want. As long as you take that money out for health expenses, it's not taxable at all. Education. If you're a teacher, educator expenses, $250, guaranteed. I know teachers out there spending a lot more than $250, especially nowadays with doing e-learning. They're paying for internet connections at their house. They're paying for supplies for their kids that the school's not covering. Automatic expense deduction. Sorry, not a credit, but it's a deduction on that tax return for the educator expenses. College expenses. This is a big one out there. If you've got a kid in college, or you yourself are going back to school, as long as you're going to a college or university, you could qualify for the American Opportunity Credit. It's $2,500 per student. So if you spend at least $4,000, you're going to get a $2,500 credit on that tax return. There are some income limitations. These are all through the tax code with any kind of credit or deduction. The more you make, there is a chance that it could get phased out. So you may need to look into the specifics of each of these items. There's also the lifetime learning credit. The American Opportunity Credit only applies to the first 4 years of undergraduate schooling. So if your student happens to take 5 years to get that undergraduate degree, they're going to have to move to the lifetime learning credit in the final year, or they're going back for a master's, excuse me, or going back for some continued education. Or if you decide to go back and take some college courses to try to expand your knowledge, you can get up to $2,000 per year under the lifetime learning credit. Some other deductions you don't want to miss: student loan interest, up to $2,500 per year deductible in student loan interest. I know that's a hot button right now. Student loan forgiveness, Congress has been kicking around this idea that they want to do that. But as long as you continue to pay those student loans, don't forget your $2,500 per year deduction. Now, the 529 plans, absolute incredible way to save on state taxes as save for college for your kids. There's a state credit for 20% of the total contributions you put into an Indiana 529 plan. Now that credit maxes out at $1,000. So here's our example. If you can, you open up a 529 plan. It must be an Indiana plan. And you can go to College Choice Direct. And then I think there's another one, the College Savings 529.com. As long as it's an Indiana plan, and it will tell you that, you could put, if you put $5,000 into that plan, you're going to get a $1,000 credit on your state tax return. That's a credit. That's a dollar for reduction. So for instance, you prepare your Indiana tax return. You go and you look and you say, okay, I put all my wages, I put my business income, it's all carried through. I owe the state of Indiana $5,000 in taxes. You plug that credit in, it goes down to $4,000. Credits are always a better dollar for dollar reduction in taxes. And right now with Indiana residents, this is one of the best ways to save on taxes. One way to look at it, I tell clients, is it's giving you an automatic 20% return on your money. You put $5,000 in, they give you a $1,000 credit. So the $5,000 in that 529 plan only costs you $4,000. That's an automatic 20% return on that money. And that account grows tax deferred, meaning you never have to report the income in that account. You never have to pay taxes on it. If and when you start to take money out of that account, as long as you're spending it on qualified education expenses, which is room, board, tuition, fees, and reasonable expenses for supplies, you don't have to pay any taxes on the earnings, and you don't have to repay the state for any of the credits. One of the best ways to save money. Now, notice the big red mark on this one. I know we kind of talked about this in one of the questions, but unreimbursed employee expenses were eliminated. Used to be able to, to calculate, to lump up all those things, unreimbursed miles, meals and entertainment, all those different items, cell phones, uniforms, all your out-of-pocket expenses that your boss didn't pay for. No longer deduct those. It was eliminated under the Tax Cuts and Jobs Act. It used to be a 2% AGI floor. It's done. And this is where I think there's going to be a lot of people who have been forced to work from home, who are employees, who are incurring some expenses for that home office they didn't have, and they're not going to be able to deduct any of those expenses this year. Some other deductions to remember as you're collecting all your tax information. For your home and property, your mortgage interest is deductible. If you have a home equity line of credit, loan of credit, as I've put it in there, and it was used for the rehabilitation or the purchase of your home. Those are some new rules with the Tax Cuts and Jobs Act. Must be for rehabilitation and purchase. Then the interest on that line of credit are now going to be deductible. Your real estate taxes that you pay on your home, deductible. Those are itemized that go on your Schedule A. Personal property taxes, Specifically, I'm referring to your BMV fees on your vehicles, your personal vehicles, not your business. Those are also deductible on a Schedule A as an itemized deduction. Now, you're going to want to keep in mind, because of the Tax Cuts and Jobs Act, the maximum standard deduction for a married filing joint tax return is now up to like $24,800. So your mortgage interest, home equity line of credit, real estate taxes, personal taxes, and charitable contributions that you make to 501c3 charities has to add up to more than $24,000. If not, you're going to want to take that standard deduction, that bigger standard deduction. But remember, real estate taxes, whether you itemize your deductions or not for federal income tax purposes, those Indiana real estate taxes are a deduction on your Indiana state return, up to $2,500. Goes right on Schedule 1 and carries over to the deductions on your tax return. So don't forget to put in your real estate taxes, even if you take the standard deduction on that 1040. Retirement. Even if you are not participating in a 401k plan with your employer, or you have a small business and haven't implemented a SEP or a simple or a 401k, you still could have an opportunity to put some money away for retirement. There's individual retirement plans. You can do a traditional IRA. And right now, as long as you have some earned income, you can put $6,000 into a traditional IRA, and it's deductible on your individual income taxes. If you're over 50, you got $1,000 catch up. You can put $7,000 in there, and you don't have to pay any taxes until you start taking that money out. You are not forced to take that money out until age 72. That's the age of required minimum distributions. It used to be 70 and a half. I believe it was the SAFE Act recently that upped it to 72. And once you turn 72, if you've got money in these qualified retirement plans, you're forced to start taking that out. Congress is then going to want to get a little bit of tax money rolling for them. A Roth IRA. A lot of clients that participate in Roth IRA. There's some great benefits to a Roth IRA. $6,000 per year, still has that $1,000 catch up if you're older than 50. But you got to remember that $6,000 or $7,000 you put in is not deductible from your adjusted gross income. There are no immediate tax benefits. The tax benefits of a Roth are going to come in retirement years because you are not taxed on the distributions, neither the principal nor the earnings over the year. None of it's taxable. So you've got to work with a financial advisor or a consultant or an accountant to determine what's the best for you. Save some taxes now and pay in retirement, or go ahead and put this post-tax money, this non-deductible money, into a Roth. There are some income limitations. You're going to want to check with your advisor on what account's going to work best for you. And you also have an opportunity. If you have a traditional IRA, you can convert it to a Roth. You're going to have to pay taxes on that conversion because that's going to be considered taxable income. Because if you've been putting in a traditional IRA, you've been writing it off on your taxes, you are then going to have to report that conversion as a taxable event, pay taxes, but then all your money is going to be in that Roth, and you're never going to have to pay taxes on it again. Well, here are some additional resources. These will be in the handouts that I'm going to send over to Bill that he can pass out to everybody. These are some really good resources that are on the IRS website. I'm not going to lie, the IRS website, sometimes it appears to be difficult to navigate, but it has a really good search tool. You can look up these publications. You can dig into them and actually look at specific examples of travel and entertainment and gift and car expenses, business expenses, how to start a business and keeping records. These are some great reference tools. If you have any other follow-up questions, look at these publications, dig into them, see what you can find out. I want to thank everybody for your time today. We have reached the end. I am happy to hang around a couple of minutes early, but I'm happy to hang around, answer some questions. If there's anything we have not covered, now's a great time to open up.
Okay, I'll start it off by a couple of questions that came in while we were doing the presentation. One is that topic of credit card rebates. You get cash back from a credit card company and it's a business credit card. What do you do?
Mm-hmm. Yep, it's a common question. Historically, the IRS tried to come after credit card rebates and credit card miles as a taxable type of item. The only thing that you have to record now in income or in the books of a business is if you actually get cash back on the card that you used in the business. For example, you have a business Capital One, and you're just using it for business expenses, and at the end of the year, they send you a check for $1,200. That's income, because what they're doing is they're giving you a refund on the business purchases that you paid for and made on that credit card. So there's two ways to record it. Number one, you can either record that rebate and lower the interest you paid on that credit card down to zero, because that rebate could be larger, or you can record it against some of the other expenses on your books. Another option is just to stick it in other income, but this only applies to those cash rebates, money that you don't have to pay, money they've given you back. And a lot of people go, well, why in the heck would I have to pay taxes on that? Well, let me kind of put it this way. You go to the store and you buy a new computer for $1,000. You think, hey, I got $1,000 business expense. I put it in the books. Well, all of a sudden, what if the store said, hey, we overcharged you. Here's $200 back. Well, at the end of the day, you only paid $800 for that computer. You cannot go ahead and record $1,000 expenditure, because now you only have an $800 expenditure. So the credit card rebates operate the same way. They're giving you money back that you paid to them. You just have to reduce your expenses or include it in other income. But that's only on business credit cards, rebates on cards that you used in business, not on personal items.
Okay, that's great. Going back to this bonus depreciation, it sounded like you started off talking about here's how you depreciate, but then you talked about this is something Congress granted, and this is something Congress granted. Could you just kind of summarize? Does anybody have to take depreciation on anything anymore? It sounded like it's all written off.
Well, in a nutshell, no. As long as your gross revenue is less than 25 million, or you don't put too much in service, because you've got Section 179 has some limits on it, but are like $500,000, then really and truly small businesses don't have to record depreciation anymore. But in our office, we consult with our clients and we use depreciation as a planning tool. For instance, you bought a big piece of equipment at the end of the year. Well, your income is close to zero, and you've already told me that, next year my income is going to be higher. Well, from a tax planning perspective, you may not want to write it off 100% this year. Maybe you just want to take enough depreciation to get your taxable income this year down to zero, and then you want some depreciation to carry over to next year. That way you save taxes that might be in a higher tax bracket next year because you expect income to go up. So to your original question, no, there's nothing that's forcing you to take depreciation because of Section 179, the $2,500 de minimis safe harbor, and the 168K bonus depreciation. Just about every small business can write off 100% of all the assets they buy. But use depreciation as a planning tool. It actually might make sense to not depreciate everything and write it all off, carry some things over to future years.
Good deal. One of the listeners gets a grant from the state, a training grant. How's that handled tax-wise?
Grant monies, like it was addressed, are typically under the IRS revenue code are going to be income. Now, you spend that money on education, training, to buy supplies, to buy assets, to buy any equipment, you get to offset that income with those expenditures. So there should be kind of a net. You get $1,000 grant, you turn around and you spend it on classes for everybody that's working for you. You get to deduct the cost of that class. So in a sense, you're not paying any taxes on that grant money because you've spent it. So yes, because it's included in income, the expenses you've incurred, you are able to deduct it.
Okay. And deduction for membership fees in industrial trade groups. Any issues there?
No, those usually fall under what we call dues and subscriptions, as long as they are industry types of organizations. Dues to, for accountants, the AICPA or the National Association of Tax Professionals. Dues to those types of organizations are considered an ordinary necessary expense. Now, memberships to like health clubs or country clubs or social clubs are not considered ordinary necessary. In fact, the IRS has issued specific guidance telling you that dues to a country club are never deductible as a business expense. Now, if you take a customer or client there for a meal, now you're looking at a meal expense, which would be deductible. But the dues to social, health, in country clubs are not deductible. They've got to be business specific. They got to be industry trade organizations, and subscriptions to industry, different types of periodicals. Even the IBJ, it's a great newspaper. Just about any business should get it, and it would be considered a subscription. It would be deductible. Absolutely.
Okay, this is a little bit more complicated. The person sending this in is a W-2 employee inside an S corp that she owns, and she has marketplace insurance. And it's I have to read this to probably make more sense to you. What dollar counts towards that estimate?
Mm-hmm.
And does the S corp profits get affected?
Yep.
And
what
does
about
this?
the draws? Mm-hmm.
Yeah. Point.
No, I think I understand the question. So, a lot of times as a small business owner, you've got an S corporation, you're paying yourself wages, but trying to get any kind of group plan is unreasonable. It's going to be too expensive. So you go out and you get some marketplace insurance. Well, you're going to run into a couple of issues. Number one, yes, it qualifies under the self-employed health insurance rules if you're paying yourself wages out of that S corporation. But you're going to have to do some calculations on your personal tax return with that marketplace insurance, especially if you're getting what are called advanced premium tax credits. And if you've gotten those, then usually what you get is that statement that says, hey, normally this insurance costs $1,000 a month for your family. But based on your application and your level of income, we anticipate you're going to get these credits. So we're just going to give them to you now, and we're going to reduce your monthly bill on this insurance down to $300. Well, now you've got to fill out some pretty complicated forms. I think it's the 8995, 8996. I think those are the two forms, and those are with your personal return. And you're going to have to go and do calculations to determine that whether or not they gave you too much in credits, those advance payment credits, they didn't give you enough, and what qualifies as the self-employed health insurance deduction. For instance, you do a calculation and it says, okay, $1,000 was the premium. They gave me a $700 premium tax credit. I only paid $300. Your income gets too high. You don't qualify for those credits. You have to repay some of those credits. Well, now the net cost of your insurance actually goes down. Or I'm sorry, your net cost goes up. How much they paid goes down. So now all of a sudden, you paid $300 a month, but then they make you pay back a bunch of credits. Let's say they make you pay back $200 a month in credits, $2,400. Well, now your cost that qualifies for that self-employed health insurance deduction went from $300 a month to $500 a month. So you now still have a self-employed health insurance deduction. So, but when you're in an S corporation and you're getting marketplace insurance, there's going to be some complicated calculations that are going to have to be handled at your personal return level, especially if you've got those advanced premium tax credits. Also, if you're in an S corporation, you want the company to pay those premiums, and there are some special rules that you have to go through. The IRS have given small business owners some flexibility to either have the business pay, as long as it's reported properly on a W-2 for the owner, or reimbursing the shareholder on a monthly basis like it's in an unreimbursed expense.
Okay, we have a few more questions. I want to jump to one that came in. New businesses that actually aren't making money, they have to file tax return, or is there any
Yeah, they do. Unfortunately, and here's normally what the rules, and you can actually look these up depending on what kind of business you have, whether it's a Schedule C, C Corp, S Corp, partnership. The rules are going to tell you that if you have any kind of reportable income or expenses, you should file a tax return. Moreover, if you have income, you got to report it. Now, what I tell clients is if you have started a new business and you're a sole proprietor and you're filing on a Schedule C and you have more expenses than you do income, yes, you're not making any money yet, but why don't you make those deductions become a tax advantage? You put them all on a Schedule C, put all your income, all your expenses. You may have created a loss. Well, if you've got other W-2 income, you've got other investment income, your spouse works, that loss is going to lower that income, and that's going to decrease your tax liability. Same thing on an S corporation, on a partnership, anything. Yeah, you got to file those taxes. Now, one of the things I do understand is a lot of people thinks that, going to an accountant is going to cost, thousands of dollars. Well, I'm happy to charge you thousands if you want, but that's not really how it works. Our tax return fees are usually a flat fee based on what your revenue or your company size. So the time that we know we're going to have to spend on preparing that tax return is going to mirror the size of the business. And that's going to, equate into the fee. As of right now, I don't know of any low price or free services for corporations or partnerships. Now, there is an IRS program called the VITA program, VITA. It's called Voluntary Income Tax Assistance. It's a volunteer program. It's run by volunteers, and they actually volunteer their time to help individuals file their taxes. So if you're a sole proprietor with a Schedule C and you can't afford an accountant or don't think you can afford an accountant, and you want to talk to someone to help you on the assistance of those taxes, do some research on the VITA program. You should be able to find it on the irs.gov website. You can or do a Google search for VITA tax program. They usually tell you the locations and the times that they're going to occur. A lot of them occur at government, municipal buildings, public library, but you'll find volunteers who have experience, who've, basically given up their time to help other people to prepare their income taxes.
Okay, Jason, we only have one question left. It simply says, are you accepting new business? And I'll answer for you. I'm sure you are.
Yeah, we're growing. I mean, we're growing every day. We hire new people constantly as the work comes in. Plus, we've got a nice little office building, as you can see by the picture. I got to fill it, so we're absolutely. And as a courtesy to any SCORE participant, normally what I do is I absolutely will do an initial consultation with any participant that's been here today, and you're not going to pay for the initial consultation. That's my gift to SCORE attendees. To anyone who works with SCORE, and that's just what we do. So the first one's free. If you have some quick questions, I usually try to limit to an hour, 45 minutes, but I'm happy to talk to you, hook you up with one of my employees. We've got more people than this. We've actually hired a lot since this picture was taken. There's 8 of us in the office now. We can hook you up with my partner, one of our tax managers, one of our accounting managers who can address your bookkeeping questions, tax questions, make sure to get you in the right direction. And then quote, if you need services on just exactly how much it would cost to help you with those, with all those year-end activities.
That's great. So I'm going to wrap this up by, first of all, thanking you, Jason. It's always a pleasure. And I make notes every time for myself. And I know that there were a half a dozen SCORE mentors also watching, and I think that the information you passed on to us will help us with our clients in a high level generation of tax information. Also, in case you arrived late, I did say that all the people who registered for this webinar will get an email from us with a link to the presentation to be watched again if you want, and also with a deck of slides that we used today. Jason's going to send those to me and I'll send them to you. And so you'll all be able to have the information even if you didn't make notes. So appreciate everybody coming. We went a little bit over, but I'm pleased that only a few people actually jumped off at 1:30. So we must be holding their attention, Jason. So thanks a lot, and I'm gonna log off.
Absolutely. Thanks, Bill. I appreciate it. We'll sign off. And if anybody has some follow-up questions, when Bill sends the information, feel free to shoot me an email and we'll make sure we get you an answer from someone.
Okay. Thanks, everyone.